looking at your analysis, and there is a benefit of hindsight here, but your view is that rates and the equity markets have been disconnected because stocks have been rising, and people were still thinking that there's a chance for a rate cut.
Exactly.
And if you go back to December, it wasn't totally clear that the recession was off the table.
Right.
So stocks and the sentiment about the economy have both moved in the same direction. We realize the economy is better as the stock market was rising. But you're saying we should have never thought a rate cut was coming.
So I wouldn't say never. I think late last year, I was pretty nervous because, global growth was decelerating. China seemed to be in free fall and financial conditions were tightening. Then we have this dovish pivot from the Fed as well as global central banks. Financial conditions have eased significantly. So that downside risk has gone. China has eased. I think, the recent data has actually shown that the global growth seems to be picking up. We haven't really seen that in Europe, but we've seen China data come out better. We've seen the U.S. data come out better. So this fear, I think, that the market had earlier this year, that have global central banks extended the cycle, or if they actually signaled that the cycle is over, I think the equity market ran with they've extended the cycle. The bond market said, no, actually, they've signaled that they're going to start easing. So I think that's what we went into this Fed meeting with, looking for cuts from the Fed. We were pricing in 25 basis points of cuts this year, another 25 basis points of cuts next year.
You were?
That was a rates market.
You got to that. You mean we as in Fed Fund.
We as in
wisdom.
You never really believed it.
I didn't really buy the rate cuts because if the economy is growing at trend, so inflation has decelerated, but inflation is notoriously volatile. So if inflation is transient, then there's no reason for the Fed to ease. Financial conditions have eased significantly. So the market has done some of that work for the Fed. There's no reason for them to ease. And I think the market shifted from in Feb and March saying that recession risk is high to over the last month saying that the Fed needs to put in insurance cuts. Why insurance cuts here is what I was struggling with.
We started off the show where, and like I said, with the benefit of hindsight, I was saying these spoiled brat traders, crack addict, free money, mainlining, easy money. They were disappointed yesterday that they weren't going to get their way with it. But no one really, by yesterday, I don't think anyone really thought. After the jobs number from last month and the GDP number and ADP and all these things, no one really thought that rate cuts. Most people, Scott Minerd, Goldman Sachs, most were saying that we've now pivoted back to where the next move, whenever it is going to be higher, not lower. Don't you think?
So I think from what we heard from Chair Powell, there was a lot of sort of expectation of inflation being transient. Now, if inflation actually doesn't pick up, what if there are structural forces, automation, technology? If that's keeping inflation low, then the Fed may not need to hike. But then I still don't see the reason for the Fed to ease. Exactly.
Well, it could still be great. That levels like this, where the inflation stays low because of those factors, and I mean these are great. Interest rates for expanding businesses and for borrowing money and everything, and paying off our, managing the debt the federal government has globally as well. Stephen, you, I don't know, you're taking a big victory lap. You say everything you predicted at the beginning of the year is coming true. Is that right? And you're looking for 3,100 on the S&P?
We've been at 3,100.
Not everyone has been. You really have?
We stuck with it. You can go look in the Barron's Roundtable. You'll see it there. I mean, we were at 3,100 and we didn't move. Yeah. And our view was whatever he's saying, his mandate is not to cause a recession. He's going to go on hold, which he did.
Yeah.
And instead of talking about, synchronous tightening, which is what we were all talking about in the fall, we're going to go to synchronous easing, which we're now talking about, and that's going to shift to synchronous global recovery. And all this talk of late cycle, which we always thought was kind of nonsense, frankly, is going to shift. I mean, how can you be late cycle when you're reaccelerating? And the economy has come through a soft patch, and by the summer it's going to be reaccelerating. We're going to get this China deal soon. And that's been holding back the industrial materials sector because everyone, that's a very important element of the global economy. Europe is a levered play on China. You're going to see all that start to move. So, and that'll be the last straw for the bears from our point of view. That's why we're talking now about a possible melt-up, which I know sounds crazy because we've had this sharp move, but all we've done is re-achieve the old highs. We haven't done anything, actually. And if you look at the situation from 6 months ago, everything is better.
Right. And multiples, you just addressed where those could go if rates stay low. And you also think the earnings recession was faux. And that at least, maybe it was a real worry at some point, but now you're seeing earnings stabilize and actually...
They've stabilized. As you know, Joe, back in the fall, right, finally, the earnings numbers were coming down for next year, which is the first time in 12, 18 months. And now they've stabilized. And in fact, as we go through the earnings season, they're ticking higher.
Right.
That doesn't happen late cycle.
And you combine that, if you're not worried about multiples contracting, then you
well,
point
okay.
for point.
I mean,
they could a little.
You know, honestly, what's going to happen next is the multiple's going to expand. This always happens after a scary event like this. People start to say, what was I worried about? And why should I not pay more for stocks, not less, in an environment where the Fed is probably on hold for at least the rest of the year? And if they do hike again, it's going to be because the economy is roaring. Right. But, you know, stocks are probably worth more. And all this worry about, you know, the end is nigh is fading. So when you come out of that, actually multiples expand. When was the last time you had a taxi driver give you a stock tip? We're not even in that.
The Uber driver, maybe.
Maybe. The Uber drivers know more about stocks now.
They should. Okay.